Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look at what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. We actually have a question and answer session at 5 p.m. today, Mountain Time, where I go in and answer all of your guys' questions. You can ask whatever you like during that meeting. You can also send the questions to me in the chat, either on Discord or you can reach out through the website chat too. Any questions that you guys have if you can't make the meeting. May Day coupon code is still active. MAYDAY. Get 50% off the first month on a monthly membership, or you can switch to a yearly membership and get further savings if you'd like. So, big companies have small moves. Small companies have big moves, says Peter Lynch. What I've found in ventures is that big companies can have big moves if you're in the commodity space. And the way that they have big moves is that you get big swings in the commodities themselves. And that's what makes commodity bull markets so fun. Because the big moves come from their margin expansion, from the big move in the commodity. And those moves don't happen frequently. They happen during big cycles. We're in one of those cycles. So you can have big companies make big moves. You can also have mid-cap companies make absolutely ridiculous moves. And then the small companies, it depends. That's where your risk reward really needs to, you got to dive into the risks. Some of the companies that are small go bankrupt. Some of the small companies do not find anything if they're an explorer. Small companies with small development projects may not get financed. So there's a sweet spot between small companies and big companies. And that's where you want to be, in my opinion. You want to be somewhere in the middle where you're not exactly in a small company, but you've got maybe like a small mid-cap company, but it's got all the upside leverage. Think of it as perhaps a big amount of reserves, higher cost production, and then when the commodity price moves, you get absolutely ridiculous returns. And some people might say, well, how big are those returns? Well, it depends when you purchased it and how patient you are. If you purchased it in 2020, 100 baggers, 200 baggers, 300 baggers are possible. And it's not every company that gets that. That's why you want to spread across a few that possess the traits that can do that, those multi baggers. So where most people trip up is they don't have a long enough time frame. They don't hold them long enough. They hit some sort of volatility and they sell out. They might be up 3, 4, 5x, and they sell out because you get a 50% pullback. And that's where they don't have the staying power to get 100 bagger, 200 bagger, 300 bagger. Even the big names, some of the big guys like Monish, and some of these other guys, they've ridden companies up like 100 times and then they've sold. And then later on, some of those companies go up another 10, 20x even from where they purchased it. And they didn't even hold long enough. So holding long enough that's what seems to be the shortfall of almost every investor. They don't take a large enough, long enough time frame. Squeaky Mouse says, possible outcome for silver to break through 35. And here we are doing a potential retest. We'll see if it holds. So that'll be interesting next week to see if silver gains support right where it's at. Bigger picture view, even if this breaks down for a little while, I don't see how this goes lower. Like, I can't think of a scenario over a 5 to 10 year period with all of the silver demand out in the future where silver goes down and stays down for a long period of time. It could go down and it could crash during a a market pullback or a recession or something like that. But that doesn't mean it's down and out for 5 or 10 years. And that's another thing that I want to say. I don't know why people are so scared of a pullback, which is almost temporary. So your account goes down temporarily, and then you can ride through it. I mean, I rode through the big sell-off in 2008, and yeah, it wasn't fun, but I just said, okay, I'm down this amount. And again, I was a new investor, and I don't know how you could sidestep the 2008 crisis if you know what to look for. But I didn't at that time, and I rode through it, and I was fine. I kept adding and buying into oil stocks like bottom of '08, '09, 2010. I bought all that bottom and rode it on up. But also, there were some other ones I bought too in mining. Tech Kaminko was a company that was $3 in 2009. I bought that and rode it over $30. Good old 10 bagger. But I am so much better prepared now than what I was. Like I'm not even near the investor back then than I am today, is what I'll say. Coming out, rule of thumb, don't take financial advice from hedge fund managers. Paul Tudor Jones says the U.S. economy is on an unsustainable path, threatening markets. February 5th, 2024. Paul Tudor Jones believes we are in or near a recession, and history shows stocks have more to fall. And that was October 10th, 2022. Stanley Druckenmiller sees hard landing in 2023 with a possible deeper recession than many expect. September 28, 2022. Legendary investor is more worried than ever. May 22nd, 2010. Hedge fund Dalio thinks the Fed can repeat 1937 all over again. And that was May 22nd, 2010. So a lot of these guys, they don't get it right. Their timing and whatnot. So it's hard to try to time the market. Even the greats, I don't think do that well. I think that if you could play the cycles and you choose the companies very wisely and you take longer holding periods, I think you can beat Paul Tudor Jones, Stanley Druckenmiller, and all these guys that are going in and out. I really think you can. But you have to have a lot of patience for good entry points. And then when you get your entry points, you got to load up. And then when you load up, it's like the train stops and moves once every 4, 5, 6, 7, 8 years. That's it. And if you can take all the money and buy it real close to the bottom, like cost average into these big bottoms, you can easily outperform the market. I mean, drastically outperform it. And that's the strategies that I've adopted. I look for things that are bottoming, I take positions, and then I just sit and wait. If you're part of the website, you guys know some of those that we've taken when platinum group metal companies were bottoming. Lithium companies are bottoming basically now. And then you can just buy them and sit and then wait. These are cyclical stocks, though. So they do cycle up and down, and at some point you do have to sell them. Oil, I bought that. A lot of my original positions were late 2020, early 2021. And I've been holding ever since because I think we're in a big bull market for oil. So do not take yearly results too seriously. Instead, focus on 4 or 5 year averages, says Warren Buffett. And that's that volatility. And what I think he's alluding to is don't get too caught up in the short-term performance because sometimes these consolidations take a little bit. And you don't want to do something that speeds up your selling, itch or emotion because if you let it ride, it could continue to perform or outperform out in the future. So don't squeeze yourself by taking too short of a time horizon and then fictitiously measuring yourself by yearly results, which is a fictitious starting point and stopping point, January and December. So you have to look at it from the big picture view. You want to look at the big cycles. And then you want to look at the companies themselves. And if the company and the tailwinds are all there, if you consolidate for a little bit, for a year or more, it's no big deal. And then you just get all of your returns in a year or two after. That's what happened. That's what happened to a lot of the oil companies. I went up a huge amount in 2020, 2021, 2022. They've consolidated since 2022, and now we're waiting for the next up leg. And um, I'm getting real optimistic for what's coming ahead for the next 3, 4, 5, 6, 7 years. I think we are going to hit a period of time where oil extraction is going to get tougher, and our flow rates aren't going to match the demand. So I think oil prices are going to go up. I think they're going to go up a lot. And with entry points where I got them, and with the companies paying dividends, buying back shares, I like what I see. I like my odds here. I like my odds a lot. Logan says clear deviation on weekly trends versus the past 2 years, and he's talking about demand for housing. It's going up. It is going up, and the pricing's going up too, is what he's seeing. And that won't hit some of the other metrics till later. Bullish Trend says cure for low prices is low prices. At current oil prices, drill baby drill is dead. Less money for new investments. OPEC will delay return of barrels. This is a cyclical industry. The longer they will artificially keep oil prices down, the higher they will go after that. I agree. And a lot of people say, well, what if Trump gets into office and he's going to do drill baby drill? I'm like, well, he can't do it. What is he going to do? He's going to force companies to take losses, because at current oil prices, they can't do that. That's why the rig count continues to decline, not go up. So at current prices, there is no drill baby drill. The prices are too low to begin with. But you could say drill baby drill if we get to 100 or 120. I could see that occurring. But at 70, I don't think so. I mean, that's break even spots for some of the Permian wells. They're all in the 60s and 70s. So why would they be pumping it if there's no reason to? Here's SPY. Flip it around for another perspective. So this is flipped. And this looks like a breakout to the upside, doesn't it? This is a topping pattern because this is an inverse S&P 500. That looks like it wants to go lower because this is an inverse of it. Ross says Buffett dumps another cool 100 million shares of Apple, bringing his stake down by nearly 70% so far this year. Meanwhile, Tim Cook, which is the CEO, and other insiders, tens of millions worth of stock. But don't worry, bulls. You've still got convicted security fraudster Dan Ives on your side. Volger has, Berkshire Hathaway's cash pile hit a fresh all-time high at $325 billion. In quarter 3, 2024, as Warren Buffett continues to refrain from major acquisitions while trimming some of his most significant equity stakes, Berkshire once again trimmed its holdings in Apple. The firm's stake in the iPhone, valued at $70 billion at the end of quarter 3, down from $84.2 billion in quarter 2, indicating that the company cut its stake. Bloomberg report says this isn't. It's more about the $325 billion that Warren Buffett is building in cash balance here. Christine says, when you think about the risk of well leaks and wastewater blowouts, remember this map of 485,000 vertical wells in the Permian Basin, colored by completion date. Look at, they just peppered this thing. So that's from 1930, which is all the dark brown stuff. That's from the 30s to the 80s. So 1930 to 1980 is the brown. All the blue and dark blue is all of the 1990s and 2000s scattered all through this Permian. Pretty interesting to see how many holes are punched in this thing. Giovanni, it says charts on crude net positioning of non-commercial accounts. equals managed money and other reportables in Brent and WTI futures and options combined. So here's net length. We're still really low on net length. We had a huge surge in 16, 17, 18. Huge pullback from 18 onward. And we've had a big pullback since 2022, coming all the way back. We're kind of dragging bottom here. This is very similar to January of 2020. Looks like later 2020, like October, September. Another one, this is where I purchased last time, was right here for this big move. I think we're going to get a huge breakout, guys, where if you draw like a trend line through here of the dark one, this is the dark one underneath here, it comes right into a corner there. And I think if we break out of that, oh, we're gonna take off. We are going to take off. Here is the net length there. You can see how low it is. It's been falling ever since 2021. And then there it is all the way back to 2011. So we had a big move higher, and then we've had a big consolidation lower. And we've been squeezing. I think at some point we'll break. At some point, whenever that is. Bar chart. So Amazon monster insider trading alert. Founder Jeff Bezos will sell $3 billion worth of Amazon shares. He's already sold over $10 billion worth this year. But I mean, what else is he going to do, guys? Is he just going to hold his shares forever? He's 60 years old. It's like, well, crap. Maybe I'd buy a jet or something. Might as well enjoy it. What are you going to do? Just leave it in there forever? When you're 60, I mean, the average age, let's just round it up to about 80 years old. You got 20 years left. I mean, might as well live it up. That's the way that I view it. Bitcoin, perfecting timing as the NASDAQ breaches its rising wedge, expecting heavy falls shortly. What he's got here, this is a schematic there. And I think this is the distribution, the Wyckoff distribution, I think. So you can see it's very similar to Wyckoff distribution. Your distribution started in 2024, potentially. And he's saying it could go down for Bitcoin versus the dollar. Is that the case? I don't know. But it looks dang similar to this. It really looks the same when you get in there and really start looking at it. It's very similar if this actually comes back down. Oil prices under different American administrations. So I thought this was interesting. That OPEC supply hike, that was declining. We had a big Gulf War under Bush, which is, these guys are both Republicans. Clinton moving sideways with Clinton. Now, here's the thing, guys. I don't think that these guys have any impact on this. I think it's driven by external factors that they do not control. So yeah, under Bush, this was Bush Jr., he had the Iraq War, but that was under that big commodity boom. So that was a commodity boom. Obama gained it on the bust. So on the bust back end, and it busted on him multiple times. Trump, it ended with a bust. And then Biden, we came back up. This is the beginning of the commodity bull market. So whether this goes down short term, I think we'll end upwards. And it doesn't matter who is in power. It doesn't matter. It could be anybody. And what the problem is that credit is outpacing the supply of oil. There's nothing that you can do. You would have, in order for you to dampen the effect, you would have to arbitrarily increase production of oil before credit expands. And I don't know why you would do that, because there'd be no signals in terms of pricing to do that. The oil sector it reacts to the oil price. It doesn't predict it necessarily. So I don't know. I just wanted to share that. Since we kick off November with WTI trading less than 70 a barrel, it's good to point out how less than 10% of U.S. operators expected to barely be breaking even here. For the past 2 years, U.S. shale has been drill baby drill with diminishing returns. So what do you expect WTI crude oil price to be at the end of 2024? And most everyone's putting, $80 to $85 of the normal distribution, 80 to 85. There's very few that have over $95 a barrel. But I don't know if this matters, guys. Like you can take all the data in the world and you get all the, expectations and people responding to surveys. Like, does it really matter though? Really what the question would be is what is the accuracy of all these surveys anyway? So you survey all this stuff, and let's say the accuracy is really low, like 30% or 40%. It's like, well, who cares then? And that's what I've got for today. So we're going to edit there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. If you subscribe to the website, Mayday coupon code. We've got that question and answer session later today at 5 p.m. Mountain Time. You log in. It's a Zoom call. You can find it on the website. Once you become a member, look at the top and look for Zoom meetings. Boom, hit the Zoom meetings. Click the link that's in that page. It'll bring you right into it. 5 p.m. Mountain Time. So if you are in a different time zone, you got to make sure that it's Mountain Time that you log in. We do that on Saturdays and Sundays. I release midweek updates during the middle of the week on Tuesday night or Wednesday morning before the Wednesday kind of opening. That's when I've been releasing them. That's where I should go over all the sectors and companies and the ones that I really like. Good entry points. Doesn't mean that I'm right 100% of the time, but I'm right a lot of the times, usually. And sometimes I'm wrong. But there's still good entry points, even if the short term dives down a little bit more or something like that. There's still good value. There's still really good long-term holds. But that's what I've got, and we'll end it there. So we'll catch you guys next time. This is Finding Value.